The most dangerous moment for a speculator is not after a great loss, but immediately after a great victory. A loss forces a man to be prudent, to re-examine his methods, to respect the power of the market. But a great win inflates the ego. It whispers in your ear that you have mastered the game, that the market is a simple machine you now understand. It tells you that your judgment is infallible. This feeling, this intoxicating euphoria of being proven right in a spectacular way, is the most expensive sensation a man can buy on Wall Street. It is the psychological doorway to ruin. Making money in the market is only the first and easiest part of the battle. The true test of a speculator, the one that separates the professionals who endure from the amateurs who vanish, is the discipline of handling profits correctly. A man can be right and still go broke. He can catch the move of a lifetime and have nothing to show for it a year later. This is because he never learned that keeping money is a separate and more difficult skill than making it. There are 4 unbreakable laws to this skill, and to ignore them is to guarantee that the market will eventually reclaim every dollar it ever paid you, with interest. The first and most important law is to let your profits run. This sounds simple, but it is the hardest thing to do in this business. The human mind is not built for it. Fear and hope are your constant companions, and they are always working against you. When you have a loss, you hope it will come back. When you have a profit, you fear it will disappear. The average man, therefore, does the exact opposite of what he should. He cuts his profits short and lets his losses run. He will sell a stock that is up 20 points to secure a sure thing, but he will hold a stock that is down 20 points, praying for a recovery that may never come. He is content to scalp a small gain, feeling clever, while the great, powerful trend of the market moves on without him. He wins a battle, but loses the war. I learned this lesson from an old trader I called Mr. Partridge, but you may know him as Old Turkey. In my early days, I would frequent a brokerage office, a place where men watched the flickering prices on the board, which was the primitive ancestor of your modern real-time data feed. I would take a position and, seeing a quick profit, sell out. I was scalping. I'd show my profitable ticket to Old Turkey, expecting a compliment. He would never give it. He would peer over his spectacles, shake his head slowly, and say, "It's a bull market, you know." It drove me mad. I would buy again, get another quick profit, and sell. Again, I'd show him. Again, he'd simply repeat, "It's a bull market, you know." One day, I finally asked him what I was supposed to do. He looked at me as if I were a child and said, "Why make big money, of course? You don't do that by taking a few points here and there. You do that by being right and sitting tight." I never forgot it. The big money is not made in the individual fluctuations. The big money is made in the great big swing, the major trend. It was never my thinking that made me the money. It was my sitting tight. It is the most difficult thing to learn. A man can see a stock going his way and be tempted to take his profit and run. But if he does, he loses his position. And when he wants to get back in, he may find the price is 20 points higher. His cowardice, his desire for a small, sure gain, has cost him the real prize. The market does not reward activity. It rewards correct judgment and patience. A speculator is not a day laborer who must be paid at the close of every session. He is a merchant who waits for the great tides of supply and demand. Therefore, the first law is an iron command. Once you have entered a trade in alignment with the major trend, your job is to do nothing. You must fight the urge to sell. You must ignore the small reactions. You must sit with the position through good days and bad until the tape itself, the raw price action, tells you that the trend has changed. Do not sell because you are scared or greedy. Sell only because your original reason for buying no longer exists. The second law is that you must not risk your profits back carelessly. After a major successful campaign, when your account is flush with cash, you are at your most vulnerable. The money feels easy. It doesn't feel like the hard-earned capital you started with. You begin to think of it as house money, a cushion you can afford to gamble with. This is a fatal delusion. There is no such thing as house money. Once the profit is in your account, it is your capital, as real and as vital as the first dollar you ever deposited. To treat it with less respect is financial suicide. I made this mistake more times than I care to remember. After a great killing, I would feel invincible. I would think I had the Midas touch. I would immediately start looking for the next play, forcing a trade where none existed, taking a flyer on a tip, or betting on a hunch that was not supported by my method. The market, which had just been so generous, would turn on me with savage speed. In a few weeks, the glorious profits would be gone, given back to the very same machine that had produced them. Jesse Livermore consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk a dollar of your own capital. To ensure this timeless wisdom translates accurately to the modern, computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. The market has a way of humbling the proud. It rewards discipline and punishes arrogance. When you are overconfident, you stop following your rules. You increase your size. You ignore warning signs. You believe you are bigger than the game. But no man is bigger than the game. The moment you believe you are, you have already lost. The feeling of invincibility is the market's most effective lure. It allows you to build a great tower of profit and then encourages you to knock it down yourself with your own hubris. Therefore, the second law is a law of humility and preservation. After you close out a significantly profitable trade, you must step away. Take a vacation. Go fishing. Do not even look at the market for a time. Allow the emotions of the victory to subside. Let your head clear. When you return, you must treat your new, larger capital with the utmost respect. Do not immediately seek another grand slam. Wait patiently for the next perfect setup, the A-plus opportunity. The profits from your last trade are the foundation for your next fortune, not chips to be thrown carelessly onto the table. Protect them as you would your life. The third law is the most practical of all. You must physically withdraw a portion of your profits. This is the law that turns a successful trader into a wealthy man. For years I made fortunes and lost them because I failed to understand this simple mechanical act. I would run my account up to millions of dollars. On the broker's ledger, I was a very rich man. I had yachts, private rail cars, and apartments all over the city. But all of it was financed by capital that remained at the office. That is, in my trading account. It was all at risk every single day. The market gives and the market takes away. A few bad decisions, a sudden turn in the trend, and the millions on that ledger could evaporate in a matter of weeks. And they did, time and time again. The paper profits vanished, the luxuries had to be sold. I was back where I started with nothing but the experience. It took me years of painful lessons to finally learn that a trading account is not a savings account. It is a war chest. It is a tool of the trade, like a carpenter's hammer. You do not store your life's savings in your toolbox. After I made a fortune in the crash of 1907, I did what I had always done. I kept the money in the market looking for the next play, and I eventually lost it. It was only much later in my career, after making another fortune, that I finally had the wisdom to do what I should have done all along. I took half of my net profits, a sum of several $1 million, and I put it into untouchable annuities and trust funds. I paid myself. I removed that capital from the battlefield entirely. It could no longer be lost due to a bad judgment call or a market panic. It was real. It was permanent. This act is the difference between being rich and staying rich. Unrealized gains are an illusion. They are a promise from the market, but that promise can be withdrawn at any moment. The only money that is truly yours is the money you have taken out of the account and put in the bank. Therefore, the third law is a non-negotiable business practice. At the conclusion of every major profitable period, whether it is a single spectacular trade or a consistently good year, you must systematically withdraw a percentage of the profits. I recommend 50%. This money is your salary. It is the tangible result of your skill and discipline. By securing it, you are building a fortress of wealth that is immune to the volatility of speculation. You are ensuring that even if you make a mistake and lose your trading stake, you will not lose everything. You will survive to fight another day. The fourth and final law for handling profits is to compound them only at the proper time. This may sound like a contradiction of the second law, which warns against risking your winnings, but it is not. It is about the intelligent application of capital when conditions are perfect. You do not get rich by taking 50% of your profits and banking them forever. You get rich by using your increased capital to take larger positions when the odds are overwhelmingly in your favor. This is the art of pyramiding, of using the market's own money to finance your conquest. But it requires the patience of a sniper. The average man, after a good trade, doubles his size on the next trade, regardless of the quality of the setup. This is gambling. The professional waits. He waits for the market to enter a powerful, confirmed trend. He waits for the leading stocks in the leading sectors to emerge. He waits for a clear pivot point, a level of resistance that, once broken, signals the line of least resistance is clear. This is when he acts. My method was always to probe first. I would never take my full position at once. I would buy a portion, say 20% of my intended line. If the stock immediately went against me, I knew my timing was wrong. I would sell it and take a small loss. No harm done. But if it moved in my favor, that was the market confirming my judgment. I would then add another 20%. If it continued to advance, I would add another portion. I was using the profits from the initial shares to cushion the risk of the later buys. I was averaging up, not down. I was adding to strength, not weakness. This is the only logical way to build a large position. You let the market itself finance your expansion. You are compounding your capital within a single high-conviction campaign. The key is that this is not done constantly. These opportunities, the ones worth betting the farm on, may only come a few times a year. In between them, you must be in a defensive posture, preserving your capital, taking small test trades, and observing. The mistake is to believe that you must be compounding all the time. You must not. Most of the time, you should be focused on defense. But when that rare, perfect moment arrives, you must have the courage and the capital to strike with decisive force. Therefore, the fourth law is the law of strategic aggression. Preserve your capital at all times, but recognize that its ultimate purpose is to be deployed. When observation, experience, and the action of the market all align to signal a major opportunity, you must be willing to bet heavily. You compound not on hope, but on confirmation. You use your accumulated profits to build a position so large that when the move is over, it changes your life. This is how you transition from making a living to making a fortune.